If you find this video helpful, please don't forget to like, share, and subscribe. So after our deep dive into the world of corporate finance, what have we ultimately learned about the stock split? Let's recap the essential truths that every investor should carry with them. First and foremost, a stock split does not fundamentally change the value of a company or the total worth of your investment. It is a cosmetic adjustment, like exchanging a large bill for smaller ones. The single most important takeaway is that you do not magically become richer just because your share count has multiplied. The pie is the same size, it has only been cut into more slices. Understanding this core principle is the foundation of a smart and rational approach, preventing you from making emotionally driven decisions. Second, we've learned that companies split their stocks for several strategic reasons, which are almost always rooted in optimism and success. The primary motivations are to make shares more psychologically affordable, to boost trading liquidity, and to send a powerful signal of confidence to the market. A forward stock split is a message from management that they believe the company has performed well and will continue to do so. Conversely, a reverse stock split is typically a sign of distress, a defensive move to avoid being delisted, and should be viewed with extreme caution by investors. Third, while the split itself is a value-neutral event, it can have real indirect effects on the market. The increased accessibility and positive publicity can lead to a surge in demand from retail investors, potentially causing a short-term rally in the stock's price. However, this effect is driven by market psychology, not by an improvement in the company's business. A savvy investor recognizes this but does not rely on it. A split should never be the sole reason to buy a stock. The excitement is temporary, but the company's underlying fundamentals, its revenue, profits, and competitive position, are what will ultimately determine long-term investment success. In conclusion, understanding stock splits is another important step on your journey to becoming a more informed and confident investor. It demystifies a common headline and equips you to look past the surface-level changes to focus on what truly matters. The company's fundamental health and its long-term growth prospects are the bedrock of any sound investment. A stock split can be a positive sign that you are invested in a thriving business, but it is the business itself, not the number of shares you own, that will build your wealth. By keeping these lessons in mind, you can navigate these events with clarity and continue to make smart, informed decisions for your financial future.